Are you tired of life insurance that feels like it's been set in stone? I mean, your life is constantly changing, right? So shouldn't your financial protection be able to keep up? Well, today we're going to dive into a whole generation of policies that are designed to be as dynamic and flexible as you are. Okay, let's get into it. This is really the big question we're asking today. If your income is set to grow, if you're thinking about starting a family, or maybe building a business, well, a rigid, one-size-fits-all policy just isn't going to cut it. We're going to look at the options that are built to adapt right alongside all of your biggest life changes.
So what does this actually mean in the real world? Well, imagine you're just out of college, you've got a new job, maybe some student loans. That high fixed premium on a traditional policy, it might be completely out of reach. But a modern, flexible policy could give you the coverage you need at a price you can actually afford now, with a clear plan for the future.
So here's our roadmap for this explainer. We'll start by talking about why we even need flexibility in the first place. Then, we'll tackle the premium puzzle for those of us with a changing budget. After that, we'll connect policies to market growth, uncover the most powerful flexible policies out there, and finally, help you figure out how to choose the right path for you.
Okay, first up, moving beyond traditional insurance. Look, let's start with the basics. Traditional whole life insurance definitely has its place. It's super stable, it's predictable. But you know what? That stability is also its biggest limitation in a world that is anything but.
And here's the real problem with that old school model. It locks you in. You get a fixed death benefit, and you pay the exact same premium forever. It's simple, sure, but it gives you zero room to maneuver when your income grows, your family gets bigger, or your financial goals totally shift. So if traditional policies can be way too rigid, what are the alternatives? Let's start by looking at policies that solve what I like to call the premium puzzle. This part is for anyone who wants permanent coverage but really needs a more manageable price tag today. This is such a common catch-22, right? You're at the start of your career, and a high premium feels like this huge mountain to climb, but you know you need that long-term protection. Well, the good news is there are policies engineered specifically for this exact phase of life. Here are two really key solutions. Think of Modified Whole Life as kind of like the starter home of permanent insurance. You get a lower, much more affordable premium for a few years, and then there's one single planned step up. Graded freemium, on the other hand, is more like walking up a staircase. Your premium takes these small annual steps up before it finally reaches its top-level landing. So what does this actually look like in practice? This timeline kind of shows the whole journey. With Modified, you have that one predictable jump. With Graded, it's a much more gradual ramp up. But the goal for both is exactly the same: to align your premium payments with your expected career and income growth, making permanent insurance accessible right from day one. And, there are other clever options too. An indeterminate premium policy is for someone who's comfortable with a little managed risk. You're basically betting that the insurance company will perform well, which could lower your costs over time, but you're always protected by a maximum price ceiling. Then there's Enhanced Whole Life, which is a cool hybrid that uses dividends to buy little bits of term insurance, plugging any gaps to keep your total coverage solid. Okay, so we've covered making premiums fit your budget. Now let's talk about making your policy's growth reflect the wider economy. This is all about moving beyond a simple, fixed rate of return. This is a really crucial question for anyone who's looking for more from their policy. I mean, what if your life insurance didn't just sit there slowly accumulating value at a predictable pace, but could actually benefit from positive economic performance? Well, the answer is a whole category of policies like Current Assumption Whole Life. Now, here's how it works. The insurance company ties the policy's performance, and by extension, your premiums or your cash value, to its current real-world experience with investments and expenses. It's sensitive to what's actually happening in the market right now. And that sensitivity, it creates some really powerful flexibility. If the insurer has a fantastic year, you get to share in that success. You can either take a sort of premium holiday and pay less, or you can keep paying the same to turbocharge your cash value. It is a two-way street, though, so if performance lags, you might need to adjust. But the key is, you're the one who gets to choose how. Now, indexed policies take this idea even further. Index Whole Life is basically your inflation shield. It ties your death benefit to the CPI, so its buying power doesn't get eroded over time. Equity indexed is for those who want a taste of stock market returns, but without all the risk. Your cash value growth is linked to an index, like the S&P 500, giving you upside potential, but with a safety net, a guaranteed minimum interest rate, so you never actually lose value. All right, now for the policies that literally hand you the keys to the car. If the options we've just talked about are about adjusting certain elements, these next policies are about putting you in the driver's seat with almost total control over your coverage. This quote really captures the whole idea behind adjustable life. The best way to think of it is as a chameleon policy. You can change it from something that looks like term insurance to something that looks like whole life and back again, just by adjusting the face amount or the premium to fit what's happening in your life, like when you get married, buy a house, or have kids. And then there's universal life, or UL, which is really in a class of its own. So what makes it so special? It all comes down to these three pillars. You have flexible premiums, you can pay more, you can pay less, you can even skip a payment if you need to. You have an adjustable death benefit, and maybe most importantly, you can access your cash value through partial withdrawals, not just loans. That is a total game changer. The secret sauce that makes all this possible is something called the unbundled premium. With UL, the insurer gives you this transparent annual report that shows you exactly how your payment is being divided up between the pure cost of the insurance, the company's expenses, and what's being funneled into your cash value. It's completely an open book, giving you total clarity. And with UL, you also get this fundamental choice. Think of it this way. With option A, you're filling a fixed size bucket, that's your death benefit, with water, which is your cash value. As the water level rises, you need less pure insurance to top it off. But with option B, as you add water, the bucket itself actually gets bigger. The payout grows right along with your cash value, maximizing what you can leave behind. So let's just put them head to head for a second. This table breaks it all down. Both of them offer adjustable death benefits. But the real distinction comes down to Universal Life's truly flexible premiums, its access to cash through partial withdrawals, and that incredible unbundled transparency. UL just gives you the absolute maximum level of control and insight. Okay, so we've laid out the entire menu of options. Now that you know what's possible, how do you actually choose the right path for you? Let's build a really simple framework to help you make that decision. Here are 3 key questions to ask yourself. First, assess your budget. Answering this is going to point you toward those modified or graded premium policies. Second, define your growth goals. This helps clarify whether you prefer a guaranteed rate or the potential of an indexed policy. And third, determine how much control you truly want. Your answer here will tell you if the ultimate flexibility of a universal life policy is the right fit. And we'll end on this thought. The whole era of one-size-fits-all insurance is pretty much over. The question is no longer if flexible policies exist, but which kind of flexibility best serves your life, both right now and in the future. So, now that you know the options, what level of flexibility does your financial future truly demand? It's time to find a policy that's as unique as you are.